Hello from the children of planet Earth.
What's up, everybody? Good morning. In non-farms today, get some movement in the market. We had a dip to lower DD bands, NASDAQ right at the open or pre-market. Cautious day already today. Talk about that data as soon as it comes through.
Hello from the children of planet Earth.
What you guys up to today? Weekend plans, trips, fun stuff. I think it maybe did. Hold on, let me see. NASDAQ. Yeah, I don't have it anymore. So. Company Christmas party. Very nice, very nice, very nice. Market opening in 3 minutes. Gotta get started here. All right, so you can look at non-farms getting rolling here. Unemployment data. Start at the top.
Hello from the children of planet Earth.
That's a downtick against the expectations. Still high-ish, you know, above the average for sure. Kind of goes hand in hand with the continual jobless claims you've been seeing, right? That number's been steadily growing. So participation rate, sorry, I'm cleaning my glasses here. Participation rate is labor supply metric. And that's been going up, so showing, you know, reflecting people that are looking for jobs and such. We got 2 minutes till market opens. Non-farms have been trending down. This is the change in the number of employed people during the previous month. So even though it's positive and shrinking, it means the change, this first derivative, is getting lower, which means it's a slowdown of growth. It's still growing, but slowing down. The change in number of people employed during the previous month. So we've been seeing, you know, this number just kind of going lower and lower and lower. And I hate that we have the COVID data always spiking everything for the rest of our lives. You know, normally it's, you know, pretty flat noise around the 200 mark. So, you know, this is all those people going back to work and such, and then the change is starting like flatline, kind of in that area where it normally sits. As kids get ready to roll. Hilo or DD band, already a caution on NASDAQ. Already have index divergence out the door. S&P slightly ahead of NASDAQ, which is good on the positive side. So see if we get anything great today off of that. Try to find myself something good. Smash that like button, friends. Give us some love if you don't mind. Subscribe to the stream. That positive resilience, and we're sitting right here, bottom of the box. Ooh, and we're right at that 77 yellow line, which is also... That is the question. It's 59, it's pretty solid. How's NASDAQ doing? Tested zero. That's why we get liquidity map come through and make a decision. I think we do get a nice little break on this. Oh, very nice, very nice. Now we're at the top of the bears. Okay, okay. Oh, this is gonna be a tough one. We might get lucky and get a dip to hedge. Okay, let me get my drawing tool here.
There are a lot of us now, and it means
so sorry, resilience greater than zero. Push top of the box. We opened, we moved up, and so I'd like to see, like, in a better world, in a better sense of like what would be the best trade setup. Clearly, the most probable move would be here and here. Long side. Ooh, we did get that little bit of a pullback here. NASDAQ resilience is negative. Let's see what we're going EVXY here. Check out, make sure any volatility issues. Do you have a long hedge? Oh, ooh, and upside is limited. All right, take a look at VIX, everybody. So upside today is very limited, and as we push up, VIX is going to be hitting monthly hedge. So kind of be careful on that one. Let's go ahead and take a little bit of a position here. Just a little bit, a couple micros. I'm gonna step in. I'm gonna step in through here. Upper target. Well, we'll see as resilience stays positive, which I'm not sure it will. I'm going to look for the market to break into the mean reversion, which will push us here in DD roll and take us at the top high a day, 59. If I get lucky. So res greater than zero, right? Hopefully those inside of the box, which will give us that power to get that DD tap. And then probably like maybe back into there. Not really anything like too crazy or irrational right now. Yeah, the best R&R would be from here to there. For sure, you guys nailed it. If you remember our red line, we talked about that yesterday. We had a little class on it. Did y'all enjoy that? You can see how we closed both of them out today. And you can see these red lines. These are those pivots there. And there's that 77 pivot we always talk about. Red line tapped. Red line pivoting here. Also tapped. So we delete them. We delete that. And there you go. Actually, let me leave the box there just so we can go back and remember where it was for future videos. It's decent enough. I'd see it's about a 10-point move. I'm not really going to put something too heavy on the table for it. Yeah, so with all the lines, none of the lights being red, opening here tends to want to close in there. Right, so the general move today is going to be like this, no matter what it does, unless there's some kind of strange excursion and we lose hedge pressure or something. The general flow and expectation today is to support on the bull side to there. ED is less than what it was, but it's still really strong and positive. Let's look at monthly map. Marine news is bearish. I wouldn't say it's bearish. I think that the market is responding. It's pretty neutral, I would say, in like my analysis of it. Market's perceiving it as somewhat neutral. I mean, there's a dip, but like, you know, the market bought right back up. I mean, this is pretty normal 200K range. This is what normal healthy, you know, non-farms usually were before COVID. That's the change. It just shows steady employment growth. But it's, even though the rate is declining, it means we're slowing down the hiring spree. And you're seeing that all over. The participation rate's going up. Jolts are, you know, coming down, but continuing jobs claims is going up. So people are having a harder time finding jobs. That means it's reaching equilibrium. But that mad rush, everybody can immediately flip into a new job overnight. And the unemployment rate, 3.7%, which is, you know, higher than it has been in the year, right? And it's kind of trending up a little bit. But that's going to be natural and what you expect to happen in the mode of post-COVID world, where, you know, the labor market's trying to equalize itself. So people are getting laid off as companies are optimizing, becoming more efficient, or just, you know, firing people that are getting paid too much, etc. Monthly maps are still strongly bullish going into at least the new year. Well, at least what we can see so far. Still decent, right? That bull zone sloping down, as you see from your cheat sheets. Everybody can take a look. By the way, your cheat sheets are now on the website. Monthly maps are one of the best tools you have for longer term diagnosis right here. The sloping down, you can see right here. The bull zones, bulls are longing more. It's more long accumulation. If our friends don't mind smashing the like button, just go down below the stream and click that little thumbs up or whatever it is. Give us some love. We'd appreciate that. And don't forget to subscribe to the stream right here every single day. The bear zone, relatively flat, but slightly slipping down slightly and then kind of slipping up a little bit. So it just kind of shows some short accumulation. So you have some shorts building and some longs accumulating harder. So you basically have an equilibrium mode in the market where everybody's sort of consolidating. You have more shorts, more longs, same time. No volatility. That's the takeaway of this as well. Those of you looking for big, giant, nasty sell, it's going to be hard to predict those to happen, because the market is not showing any signs of volatility. Maybe there could be some volatility leading into expiration, right? This is this week. But other than that, I mean, like, it's just nice and tight until we get to about the beginning of the year. The spaces between the zones get larger. So it's looking pretty solid. Loving the lo-fi. Oh, thanks, man. I know, I dig it. Like, it's just chill tunes for the morning. Alright, so that bull long up still. I mean, like, this is kind of the upper limit. I have something on the table just to give us something. Resilience is kind of going down negative right now, trying to fight here at least. I kind of do want to get a better trade. Let me close that out. I want to get a better trade off a hedge pressure. I just took whatever 30 bucks that was. This is kind of fighting a little bit here. I would rather have a better push off of there. I need to get a little bit bigger stretch. I want to get at least, you know, maybe 20 points off of that. I don't know. If this does that, that'd be kind of a better setup. I don't know. I just went ahead and closed out just because it's not getting the momentum I want. We had some green up candles and resilience was negative, so I went ahead and closed out, like, we're literally right there. I only had 3 micros. It wasn't anything big. I'm not, these consolidating plays, not the greatest. So let's look at liquidity map here. Take a look at what we see. We have a little divergence here with right. You have to kind of pay attention to this. The resilience number, it needs to be fighting a little harder than this. I mean, it's sitting around 0. Okay, they're finally now gets to me, right? Something just pushed, which is good. Like I said, I do feel upside today more than I feel downside. I would rather have a better entry on this. I just, you know, kind of jumping in right here and closing there and just, I don't know. I mean, it looks better now. Definitely not going to short it. This is the trade I wanted, so it looks like it is taking off. Oh yeah, we have the mission data coming up in about 15 minutes, so it could cause a little volatility here. My bad, my bad. Hold on. Let me start over. I had the mic muted. I was snacking on my breakfast. All right, here we go. So remember, any upside move and downside move on the VIX, VIX can have interaction points between hedge pressures. Remember, anytime VIX can bounce, I take note of that in my trading. So an example is if this continues to go up and up and up, and VIX hits here, and VIX is trading higher. Anytime VIX is hedging itself higher, you just know you're holding onto a ticking time bomb where volatility can start to make its way into the trade. I'm just drawing random Vs, but you know, it can get choppier up here. So we always know that usually I start to exit longs anytime I can get a VIX bounce. One of our rules here, right? So anytime you have VIX can pivot higher with certainty at a pivot is usually where I exit out any long that I do have. I was explaining something to my cat and myself. At least Fuki got it, right, boy? No, he ran off. He wasn't. He didn't like it either. What is my opinion of Cannes? I don't know what that is, Sandis. Isn't that a city? That name sounds familiar. Is that biblical? Is that a company name? Can stock. Oh. I was like, that's a... It sounds like a city. Canaan Inc. I have no idea what that company is. Kind of like Upstart. What do they do? China-based computer hardware manufacturer. Oh, so I'm not too familiar with what they do. Apologize. Let's take a look at it though and see what the reading is. On a fundamental side, I'm not really sure what their products are, and it's a penny stock. That's why. I only usually don't focus on a lot of small caps personally, and like our data is not bringing. We don't have any options for it to kind of make an analysis. So unfortunately, don't know. Was that like one of the hot stocks today or something? Tell me about it. Freaky be the top trader 20. He's a great trader. He gets a lot of free gains every morning. He gets his dry food and his wet food. You don't have to do anything except knock over candles all night and make noise. All right, so we're gonna wait for the Michigan numbers to come out in 7 minutes and take a look at the market then. Let's see what we got. I'm feeling this is going to be a tough day. It's kind of a hard read. I think that the market's spanning this middle of the two areas that I kind of drew. Right? Bull zone about that 4,600. We have hedge pressure here. Keep an eye on res, right? It's just showing you how the market. So what resilience does is kind of point to which direction of the box it's preferring. If it's greater than 0, right, it likes to flux towards the top of the box. If it's less than 0, this is the arbitrage from the S&P and the stocks inside of it. Mining machines and it follows Bitcoin. Oh, that's cool. Yeah, unfortunately, I don't really pay a lot of attention to small caps, kind of outside of my forte. And like, if it doesn't have options, we can't draw a liquidity map for it. So unfortunately, we're kind of in the dark on that one. EVXY is like a hot dog down a hallway right now. It's a bit lost, pretty much. Okay, about 5 more minutes that news comes through, so we're gonna hang out on that, kind of take a look at it. The question I have is, what am I going to do if we bounce the hedge pressure right now? Would I take that long for it to like jump back up? And I think I would. Remember, 45.77 is that yellow line over here. I gotta check my calendar real quick. Yeah, a couple more minutes here. Okay. All right. All right, here we go. Looks like we got a little something going on here. All right, take a look. The Michigan numbers coming out in just about 1 minute here. You've been holding breeze for a while, been starting to move upward lately. Any of it? I don't really do much. Again, let me. If these are small caps, I'm gonna tell you. Breeze? Oh no. Okay, this is not a small cap. Let's take a look at it. So, oops. Let's see if we have really quick. Just get this up. What's going on? If there's options for it, we should have a liquidity map. So it doesn't look like we have anything for this one as well. That's strange. I don't think we have any data for that one. It's supporting it. It's was trading and supporting at the open, so it's pretty decent. I don't know why we don't have options data for that. We should. Oh, you know what? If it's a stock that nobody's ever looked at, it's not on our list to pull the data for. So we'll have it tomorrow morning. So we have this like dynamic list that as users use our platform, there's infinite number of stocks out there. So if nobody's ever called it, it won't have data. So it'll be there tomorrow. Unfortunately, it's one of those ones I've never looked up. We'll come back and check it on Monday. There's that bull zone tap. Yep. There it is, right on the line I drew for the most part. Sitting right there pretty. Those numbers came out looking pretty decent. Current conditions, consumer sentiment, and consumer expectations. 5-year inflation and 1-year inflation expectation. So this is probably the peak there. Honestly, I would close out if I was in anything right now and call it a day. So that's coming in blazing high, right? This is the consumer expectations, which this is the index that contains the two components. We're going to talk about this in a second. 66 is massive. I mean, it's one of the bigger reads that it's been in a couple of years, Oops. This is the consumer expectations, consumer sentiment, again, a huge beat off of those numbers, those expectations. And then, I mean, this is just, they're all huge across the board. All right, that's the current conditions. They opened that one twice. Yep. And sentiment, conditions, okay, and expectation. Those came in on beats. The expectations in general came in as a massive beat. So the inflation expectation, which is really important to kind of guess, you know, see what these numbers just say about the Fed. Obviously, inflation expectation is going up. What that really means, you know, in that particular light, is that, you know, the perception of inflation against, you know, people's spending power, what they're getting paid and things like that has still been going up, you know, and not coming down. People are still feeling it in houses, cars, everything. I mean, that it's there. And so the higher the number is, you know, the higher probability the Fed's going to take action to, you know, still maintain their aggressive rate hikes over the course of time. Maybe not this next year. Fed's obviously tapering off and probably going to cut rates sometime early in the year, just to, I guess, maybe stimulate things. I really don't know the point there, but they're going to have to keep driving it harder as the years go by. Maybe if they take a quarter, one or two. My thought about the interest rate is that, you know, interest rates went up and they're flat and they may cut one or two times just to give the market some hope. And then once the market's going to all-time highs, the Fed's going to keep raising rates aggressively. I'm going to tell you, last 2 years, I've been saying we're going to go to a 10% funds rate by 2025. And I'm still in the same boat. We will. And these numbers imply that the Fed is not done raising rates. The thing is, if you study historic Fed rate hikes, there are periods, and I always refer to the 1982 to 84 period, and also in 96 as well. There's a similar approach, similar, not the same, but similar. It wasn't a bear market like there was in 82, but you had rate hikes accompanying a bull market, right? The market just became stable and was growing enough it can accompany rate hikes, and the Fed rate hikes were just not even jolting the market. We're in an environment right now where rate hikes and rate cuts, the market's very sensitive to it. But in that era, Reagan era, you know, bull market, there was just no sensitivity to it at all. The market didn't care whatsoever, which is interesting. Yeah, like it's gonna force his hand to raise again, I think, but like not anytime soon. I think that the Fed is committed to the narrative just being relaxation. But yeah, it does imply that after, you know, I'm gonna say by summer or later next year, we're back to aggressive rate hikes. And I mean, I'm talking aggressive, not just a quarter of a point, but half a point to a point. They're gonna really turn it up. They just have to make sure that the stock market isn't, you know, collapsing while they do that, because in QT there's no liquidity from, you know, the Fed in many of these asset classes, so you're not going to have that resilience to movement. So like as long as they, you know, drive rate hikes like this, oh god, we're going to feed right into that as traders. Every time they're cutting rates, everybody's going to come out and be the most bullish they've ever been, and they aggressively turn it on. All you can do is say we're going to cut rates, and the market's going to do that. And so they need to get the stock market comfortably at highs to protect the labor market. Then all of a sudden they can comfortably raise rates as fast as they want, and then everybody's happy. As long as the narrative's not super aggressive and, you know, any announcement, oh yeah, we're going to cut rates, and the market's going to literally get way up there, right? And then it can absorb the bad news a little better, right? With the employment, yeah, like half a point to a point, probably even bigger than that, I'd say, because you used to see big rate hikes back in the day, but only if the market can handle it. If inflation's rapidly getting out of control, which it looks like it's starting to grow very quickly, especially the expectations numbers, right? The 1 year has been down. This is a current reflection of what we see. This almost mirrors the CPI, right? But the 5 year is still going up, and that's anticipated. People aren't seeing this go away. Right, so that's a big deal in everything, right? So the longer haul, it means a longer haul, they're likely to go a little more aggressive, and that is expected. I think so. I mean, this is the rare case to hit bull zone and keep going. Like I said, I wouldn't be shorting anything here. Everything's looking great. I'm just not. I just wasn't taking anything. And normally, a bull zone support with a 1 point stop under here would be great. But again, this was a dice roll. It popped up there. Honestly, just don't want to trade this one today. This is just a little too many jolty catalysts coming up. Yeah. Here's that 4,600 again. Yeah, it's looking good. Like, honestly, the market's looking really good. I think we still crawl our way higher and then try to trade down again next week a little bit. There's a little volatility coming out next week. Some big news events coming out next week. Yeah, so nothing really too crazy right now. Yeah, nice trade. Nice trade. I mean, you just can't argue with the greater bull market. DD's bullish. Liquidity maps are bullish. Monthly maps are bullish. Trading above monthly hedge pressure, above structure. All the things line up for the greater bull market. Yeah. Nasdaq's probably pushing all the way up to upper DD. Let's go back and check out Nasdaq really quick. Nasdaq is all over the place right now. I love it. What's likely we close in bear zone? I mean, I'm not gonna lie, it's a more probable thing than not. But I don't. What I do is I don't try to bet if this happens. I don't try to bet that this happens, right? But what I do like to do is if this comes in here, then I can make that bet. And like I'll take the confirmed trade to the downside. But I never bet like on bull zone breaks against the market on that probability. It's more probable than not that it does close down here on the average of all days you look at this, right? Granted, there is no catalyst, right? There's all the rules of like no red lights, but also catalyst does count for that. So obviously this could be one of those days where there's an event that pushes up here, like normal ebb and flow, right? The normal ebb and flow of the market. An event has created this move, so the probability is not necessarily overwhelming that you would come back to here just on that structure. Even though in a normal day, the likelihood is, of course, yes, right, makes sense. Yeah. So if I were to want to fade it back to bear zone, I would want to be here. If I were to be shorting, I need to short off of something, right? There's nothing to short off of. So normally these bull side breaks, I like to be long on them if I want to. It's not, we don't have a rule that we teach for that, but because normally on a normal day, if you get to here, that's usually the end of the day from the bear zone, because more often than not, it comes back down. Breaking and going is the rare case. An event catalyst can be, it would be a red light if there was a catalyst that was created off of that. Same thing. So events can, overwhelm those statistics. So really it's just a coin flip from now. Yeah. Yeah, like nobody here is bearish, I don't think, in this group. We've been perpetually bullish since the bottom, since October of 2022. And the Fitch slap was the one time we were getting nervous about the market. A little downgrade, kicked the market down for 3 months, and we're right back up to where we started. A very prominent short squeeze being built up. You can see on the commitment traders. Here. Like in general, since May of 23, the blue line, the leveraged fund, hedge fund that was really short, I guess in this region right here. Like building shorts, like really shorting this market to just die. I've been getting squeezed since summer of last year, and even though there's waves, in general, the trajectory is up. They've been squeezed pretty hard. So right now, there's growing liquidity. You have asset managers have really been buying the dip over the last month. Hedge funds have been shorting again. When these two lines, the blue and the green, fan out from each other, it's a very stable market. Here's some examples of that. Like when they fan away from each other. Like this right here. You got buyers and sellers shorting against each other. Stable market, non-volatile. That was actually in a bear market rally a couple months on that one, right? You can see that pattern is very easy to see. Anytime they fan out, even that, something as minuscule as that and that is enough to create stability in the market. Do y'all see a pattern the way that this looks? That looks. It's not trading up like that. It's non-volatile. Look how thin this is. Look how thin that is, right? The candles are very small and they just move along. Apart from that, I mean, you can just see that there's not a lot of up and down in these regions. It just goes straight there. It's very common. It's a very volatile, and this pattern right here, volatility is usually collapsing, and we're seeing that right now. It's the same thing. Learn how to read the commitment traders. You guys, like one of the best things about the market. You'll see that, which is great. It's such a neat thing to just, let me just redo what I had on there. When the asset managers or net long is increasing and the hedge funds net short is increasing, shorts and longs are trading against each other. And you're going to see that in some modes, dealers are, shorting more, longing more. So forgetting about the dealer line, the red one, just when you have liquidity between actual speculative traders, shorts and longs, you're looking for that like funnel look where green is up, blue is down. You're going to see that the market just moves without a lot of hesitation and without a lot of really big days. It's just non-volatile and it just crawls higher. Liquid markets don't crash. Liquid markets tend to inflate and go higher. This is pure liquidity. When buyers and sellers are fighting each other right here, liquid markets tend to just typically float up while volatility decays. So put the call ratio is usually greater than 0 because there's more longs and shorts. Clearly, if you see that is reflected here, why do balanced markets tend to go up? Well, because the green line is sloping like that and the blue line is sloping like that. You usually will see the green line sloping harder than the blue because there's more active longs than active shorts on the speculative side of the market. The green, while they're fanning out, the angle isn't the same. Like if you're doing a little geometry, what you normally will see is that this is always slightly bigger than that for the most part because there's more money on the long side of the market than there is the short side of the market, pretty much at all times. The average net long position of asset managers is almost always greater than the absolute value of the net short of the hedge funds. This being in the millions of position and this being in the minus couple 100,000. They're always more long than short. So the hedges against longs, sorry, not 0. The puts against the longs versus the calls against the shorts, more puts than calls, but the call ratio almost always greater than 1. Therefore, the squeezing of puts or preventation of puts to go into the money, the hedging against that and the longing of the market starts squeezing calls slowly, and then the market just creeps up slowly because you have way more puts than calls. So the market just like bumps, some calls go in the money, forces some more longs, and then bumps a little bit of calls go in the money, et cetera, et cetera. If the market response needs to become volatile in a market like this where there's a bad news event, because the call ratio is so much greater than 1, many more puts against calls. If there was a bad news event, the market will collapse very heavily, i.e. with COVID. So any kind of really devastating news that can spark volatility can cause a chain reaction of forcing put sellers to short the market to go with it. Anyways, that's why non-volatile markets don't crash. We always talk about that. Liquid markets don't crash. They just inch up higher. They don't usually break out hundreds of points a day either. You take them with a grain of salt and take every move a little bit. They just will go and go and go and go and go and just trickle higher. But that is a really good takeaway. If you guys ever want to learn how to read that, we teach a lot of class on reading this thing. You're looking for just like the market just is inching along nice and clean. Not a lot of volatility in this market. So liquidity and volatility are inversely related or inversely proportional. So right now you're getting the dip is being bought. This dip is being bought. Right? Longs are becoming more long, which is good to see. Like I said in podcast last year, I would say like actually no, right about here, right when I was talking about it, when monthly maps are great before the Fitch thing happened, we were saying the S&P would be 5,000 by the end of the year at the rate we were going. And this happened, and then all of a sudden it's like it's back to it. So it's very possible that we get there. I do think we go to 5,000, 5,500. That's where I do think we go before the summer. I'm still on that same boat. That scared me for a little bit when monthly maps are saying that, but then right about here, Ashton and I saw that it was bullish again, and the market was back to cleaning itself up. And so with the liquidity on the committed traders, there's really no fear of this market right now. If the Fed's committed to cutting rates, it's even better. That's good. When do I roll over contracts? Usually the volume is more from one contract to the next. I tend to just physically roll over at that point. All right, you guys, I'm gonna call it a day. Not really much going on here. Let's go ahead and just kind of let it do its thing. I'm gonna go ahead and kind of come out. I'm not doing any trades today, so let's just call it. I gotta run to a meeting, so I will see y'all later. Love you guys and have a good one. Got some marketplace stuff to work on today. Love you guys. Yeah, good luck everybody today. Market looks like it's pretty stable and solid. I like it. All right, we'll see y'all later.